macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Welcome back to Cook's Kitchen. I'm Kevin Cook. We're trying to answer the question in this correction if there is a significant change of character for the market and if we are headed towards a much bigger double-digit correction. Let's go to some charts. First up, this is a chart I showed you 2 weeks ago. I haven't done this in 2 weeks. This is the S&P 1500 high-low percent. And what I'm pointing out here on a 3-year chart is when we get this oversold, it is a buying opportunity. So you can see where we've been down here. But since this, heading towards this 5% level where, new highs are under new lows on a percentage basis, this particular index has been down to 10% at least twice. So we're getting in this territory of double dips down to 10%, which are extremely oversold. But as I noted here 2 weeks ago, approaching oversold. But if we are in for our first double-digit correction, hang on because it's going to get worse. Well, that was when the S&P was well above 1900, and now this morning we're below 1850. All right, next up I want to show you on the NYSE composite the number of stocks below their 200-day moving average. All right, first a word about the NYSE. Anywhere from 2,000 to 2,500 stocks. It's hard to figure out. The NYSE on their website says 2,500 stocks. I think that's the number they just run with. It's probably less, but the big key here is that it includes lots of small caps, lots of mid caps, and that's why the NYSE led lower, was breaking down below its 200-day moving average before the S&P, before the Dow. The other thing is it's got a lot of ADRs, a lot of Chinese stocks, a lot of big name foreign stocks, and so as those have corrected from Europe and China, that's impacted the NYSE. That's a big difference to note. Okay, here we're looking at, again, the number of NYSE stocks below their 200-day moving average. As of yesterday, 769 stocks below. That's about 30%. So that's how you get close to 2,500 stocks in the NYSE composite, not including ETFs, not including REITs, not including closed-end funds, just stocks and ADRs. All right, what's significant here? Well, let's go back and look at 2012. Yes, we are below the levels of the corrections that we had in 2012. So this is getting deeply oversold. I'm not going to show you the S&P, but if I did, the S&P has, let's see, only 200 stocks above their 200-day moving average. So only 40% of the index is above its 200-day moving average. And same scenario here as the NYSE, that is below the levels of the corrections we had in 2012. So right now, we're sort of building some evidence that we're reaching deeply oversold levels, but those could persist if the correction really gets rolling. Now let's take a look at some things that tell us the correction could get deeper. All right. Here is the S&P equal weight. This is another way I look at breadth, just like looking at the NYSE. It's a very simple way to look at breadth. This is a daily chart, and I've got 200, 300, and 400-day moving averages on here. Now, if this was all you showed me was this chart, I would say this correction is near done. You want to be a buyer of the S&P equal weight under the 300-day moving average. And that's what we did here. The red line is the 300-day moving average. This morning, we dipped well below it. Here's the 400-day moving average at 2,800 on the equal weight. And this low here, from this high of 3180 to this low today of 2866, that is a 9.9% correction. So the S&P equal weight has almost made its 10% correction. So even though I would be nibbling here as a buyer because I don't see a recession and earnings should still be solid, for the next few quarters, that's the case for your building positions here. But I still think there's a very good chance that the S&P does see a double-digit correction, and so the equal weight stopping shy of 10% isn't good enough, but it is a short-term buy. All right. Next up, let's see where is support. If the S&P does go into a double-digit correction, where is support. I'm going to show you my areas of demand. Before I forget, I want to point out the RSI. This is a weekly chart. So when do you see the RSI get this weak on the weekly chart? Only when you have a very big correction. So, if this thing gets down below 35% into 30%, that's a buy signal too. Now, so is there a crash coming? No, no crash, no recession. So there's no, is there a catalyst for a crash? Problems in Europe, oil collapsing, semiconductors getting hit. I don't see the crash scenario, and there's no systemic issues for the economy or the financial system. But let's talk double-digit correction, all right? So this is a garden variety one to me. I've put areas of demand from 1850 down to 1700 every 50 points. And not just because, 50 points is easy to remember, but because if you look back at price, these were congestion areas. 1850 is the base, that we built in the spring before we went on to make new highs. We are trading below 1850 this morning, so that could be a problem if we close here. Then I think 1800 comes really quick. Here was significant congestion for the 1800 level in late 2013, early 2014. Then 1750 comes in for obvious reasons. 1740 was the low in February. And then 1700. 1700 was a lid on this market for 6 months in 2013. It will be obvious support for some various reasons. All right. I want to mention, I showed you the S&P high-low percent index. When that thing's getting pummeled and going down 8% and making some double and triple dips down there, it is a sign of exhaustion. The sellers are getting exhausted. There's capitulation. There's probably multiple 90% down days where you have 90% of stocks down and 90% of the volume down, and those are capitulation days where you want to be buying. All right, what do I want to show you next? The stocks. Obviously, this is impacting, it's impacting the stock market, but it's also, this disaster last week when Microchip warned and just waylaid the semiconductor index, which had been pretty strong, is a tale about the economy too. It's about global demand. Not everyone, a lot of semiconductor experts who listen to the CEO of Microchip talk about how this was the top of the cycle. They said, who's he to call the top of the cycle? Well, that same day, Goldman Sachs chip analysts put out a note that they agree with him. It is the top of the semiconductor cycle, and so some of these stocks will have 15 to 20% more downside. That's a pretty significant warning, something you want to pay attention to. All right, what do we got next? My last chart of the day. Let's look at the NASDAQ 100. The lone survivor, or the sole survivor above its 200-day moving average as far as a major index goes, just gave it up today. Now finally fell underneath the 200-day moving average. Intel probably didn't help there, and so what do you say about this index? It's just going to follow the others until it finds some significant support here, down in the 35, 36 area, which was its base, its correction base earlier this year. It's no time to be a hero and try and buy extremely oversold conditions, but if you're a longer-term investor with a 6 to 12-month horizon, you definitely want to be taking a look at beaten down quality names, and we're not in the heart of earnings season yet. Next week, October 20th, that's the first week we get over 130 S&P companies reporting, and the following week we'll have another 130 S&P companies. So 10 days from now, you're looking at half the S&P will be in the bag, and this could be a significant catalyst to help us find a bottom in what is beginning to look like the S&P's first double-digit correction in a couple years. Let me just check my notes and see if I left out anything extremely important. I think I got it all. And again, you know, take a look at these charts. These are all charts that I pulled from stockcharts.com. Very easy to pull this stuff up. It's all free. And you know, these are the kind of signals you want to be monitoring. I've been showing them to you for a couple weeks now, and it's paid off if you've used them. So you want to continue to use them. And I will definitely be back next week to take a closer look at all this stuff. I'm Kevin Cook. Thanks for joining me in the kitchen.